recently we had a customer come to us whom we had helped place a mortgage for a few years ago, and for a whole bunch of reasons, it was a 5-year mortgage. They're about a year and a half into it, or 2 years, and they've had some life events change their circumstances, and so now they've made the decision to move, and they'd like to port their mortgage. Seems pretty simple. So whatever the mortgage balance was on the old property, they would just like to port it across to the new property. So they gave us a call and they said, look, we'd like to port. What do we need to know? And so as we went through the exercise, there were a few things that came out that as we were going through, we thought it would be important to share with you. And so when you're porting a mortgage, there's a couple things that you should know. First of all, when you apply for a mortgage, the banks will all use an interest rate to determine whether or not you can afford the mortgage, and that's pretty straightforward. But when you port a mortgage, some banks will use a higher rate to determine whether or not you can afford the mortgage. And so as an example, in this particular case, the interest rate on the mortgage was 3.1%, and she wanted to port it across to the new property. So we called the lender and said, look, one of your clients that we've helped would like to port the mortgage, and they said, great. Submit the application to us, but use 4.39% as the interest rate. And we thought, well, why would we do that? The interest rate is 3.1, we're porting it across, same amortization. But anyway, that was the bank's policy. So unfortunately, at 4.39%, this particular customer, by the bank's calculation, can't afford the mortgage. Even though the interest rate of the mortgage is not 4.39%, the bank is still using 4.39% to determine whether or not they can still afford the mortgage. So now the client's in a position of saying, oh wow, at 4.39% I can't port my mortgage. Apparently I can't afford it, so what do I do? Well, with the proceeds that I'm going to get from the sale of my existing property, I guess I'm going to have to use it now to pay off a bunch of debt. And so now they're going to have to pay off debt so that their affordability comes more in line with what the bank would expect. And so that, the client wasn't ready for that. That obviously changes their plans a little bit because they had hoped that they could use that money for something else. So then the client said to us, well, why don't I consider just refinancing my property? If the bank is telling me I can't afford it because they're using this interest rate, could I just reapply for a new mortgage and qualify at 3.1% or 2.89%? And so of course we're going to help her with that decision, but that raises an interesting point because now she has a payout penalty. So the interest rate when she got the mortgage is 3.1. Today that same interest rate would be 2.89. So she's not going to be charged 3 months interest. She's going to be charged the difference between those two rates. So now she's faced with this decision of, okay, well, do I port my mortgage and pay off all my debt, keep 3.1%, or do I simply just refinance, use that money for the other purposes I had it earmarked for, and reset my amortization to 25 years. So if you're considering porting your mortgage, there's lots of things you should know. Jump on emilynow.ca to learn a little bit about what the payments are going to be, what the interest rates are going to be, and how porting a mortgage may be a good decision and may not be a good decision. And it'll be our team that can help you with that. So emilynow.ca doesn't cost anything to get started, doesn't cost anything to have an account, and we certainly would love to help you with what could be one of the biggest financial decisions you'll make in your lifetime.